A very good evening, all. I'm Professor Soumya M from the team GIBS Business School, Bangalore. Today, we are all connected as a part of GIBS IRE Talk. The IRE Talks Forum brings together inspirational speakers to deliver sessions related to innovation, research, and entrepreneurship. Today's IRE topic is expectation from financial markets in 2023. And the keynote speaker for the IRE talk is Mr. Kirron Bindu, Chief Learning Officer's talk by Professor of Practice in Finance. Thank you for accepting our invitation for GIBS IRE talk series, sir. I welcome all the participants to this IRE talk on behalf of GIBS family. Please allow me to talk a few words about GIBS Business School before we begin. Global Institute of Business Studies is a place where talents are nurtured, ambitions cherished, ideas shared, and dreams fulfilled. GIBS Business School is a part of Goel Educational Trust, which is an exclusive business school based in Bangalore, Karnataka. GIBS Business School provides an AICTE approved PGDM program and BBA from Bangalore University, and we are delighted to announce that recently GIBS has ranked 5th Emerging B School in India and the 9th Best B School for BBA placement in Times of India 2022. To prepare its students for success, GIBS designed the Industry 4.0 curriculum and introduced a number of unique programs for GIBS students like Innovation, Research and Entrepreneurship, which we call it as IRE program, Finishing School, GFS, Sports Management Certification Program, and Business Mastery Program, etc. It gives us great pleasure to announce the last week GIBS has ranked A triple plus by Business India 2022, and GIBS has been awarded as Business School of the Year South by Outlook 2022. I would like to extend a warm greeting to Mr. Kirron Bindu, the resource person of today's IRE talks. Sir, we are grateful to have you, sir, and you have accepted the invitation to participate in this webinar as a keynote speaker, sir. It's my pleasure to moderate your session. Today's IRE topic is expectations from financial markets in 2023. It's my honor to introduce Mr. Kirron Bindu. He works as a principal with Mellon Capital, a company that specializes in ESOP and M&A transaction advisory. Companies like IndusLeague Clothing Limited, MCS Software Consulting, and System Domain are among his previous employers. He had provided finance corporate training for Symbol Technologies, Oracle, HP, Northern Trust, and other companies. As a mentor at the prestigious accelerator named Kirron between 2013 and 2016, he assisted over a dozen promising tech startups with their financial forecast and valuation efforts. Since 2002, Kirron Bindu has taught in every single non-IIMB B school in Bangalore, including GIBS, Christ University, Alliance Business Academy, National School of Business, IBS Bangalore, Symbiosis, NMIMS, Wellingers, PES College, IBA, Jain University, Dayanand Sagar University, and many more. I request all the participants to post your questions or doubts in Q&A session we will take up at the end of the session. Over to you, sir.
Thank you so much for inviting me. So we will get started without further ado. So although it says global financial markets, I'm going to first talk about India and what we have seen in India in the year that has gone by and how that sets a stage to what I likely expect to happen in 2023. When I say financial markets, I include equity markets, bond markets, currency markets, credit markets, commodity markets, derivative markets, real estate markets. These are the 7 things that I am going to be trying to cover in the span of time that I have in 1 hour. So equities outperformed in India, and Nifty even touched 21,000. Right now, Indian equities are looking very expensive. We will consider 1 year forward earnings and discounted to the present. The interest rates, which have gone up substantially, which is a negative for the financial markets, is likely to taper down by mid-June, July, when the Fed is likely to taper down interest rates. Commodity prices are in the solid bull run. This time, ExxonMobil and oil are all the commodities that have really shot up and given positive returns to the investors. So commodity prices will trend up thanks to inflationary pressures. All of you know that worldwide we are facing enormous inflation pressures. And there is a pent-up demand for housing. In India, the story is that of pent-up demand, mobility, EV, FMCG, and all of those things, the demand will be robust. I believe that the asset monetization scheme of the central government, wherein they wanted to sell various highways, etc., to people like BlackRock, will run into rough weather because of global interest rates being very high. They would not have the appetite to borrow at high interest rates and buy Indian assets. Rupee will continue to weaken. I will tell you how much it will weaken in the next 10 years. I believe that 87 is going to be taken out by May. GDP growth forecast for 2023, my estimate is about 8.5 we are going to grow. That should not be a problem for us. Then large cap valuations are not cheap. Large cap is never cheap because they represent the highest quality companies. If you're going to buy something of quality, you have to be expected to pay more for that. Then there are opportunities in the mid cap and the small cap spaces. Selectively, you can buy mid cap and small cap. The biggest worry in environment we have today is growth. And fortunately, when the country is growing at 8.5, most of the sectors will be growing at 20 plus. So markets will reward companies that can grow in this environment. We are in a multi-year bull market that is higher highs and higher lows. And that is going to continue. Whatever pullback you see is an intermittent pullback where profit booking is taking place. So we are still in the multi-year bull market. Real estate economy is going to do very well because companies have deleveraged their balance sheet, the real estate companies, and new projects are going to happen. So domestic indicators, the high frequency indicators that the government releases are all looking quite robust. So India can prove to be a good shelter for global fund managers also if they want to allocate some of their assets in India. Emerging markets, that is non-India, I don't consider India anymore as an emerging market, but still the world is to catch up with us. But emerging markets means the others, non-India. I will show you that how rupee has withstood the onslaught of dollar in a little bit. Dollar weakening is going to help them, and dollar is likely to weaken when the Fed starts to taper interest rates sometime in the mid of June, July. In India, the purchasing manufacture index of services is very good. Manufacturing, not so much. So in the last quarter, we have had a good, robust financials, healthcare companies performing very well, and in terms of earnings. Then manufacturing has slowed down, obviously, but the India's service story is intact. Service is growing very well. Then likely to be a choice of foreign institutional investors for emerging market investing. So they have really clearly realized that every time when we top the tables of World Bank's GDP growth rate, that there is something extra happening here that their models are not able to capture. So there is a good case for FIIs investing more money in India. Then many sectors that have been beaten down and also due to COVID makes them an attractive investment destination. Then as I told you, the real estate companies are likely to have a good year because they have reduced their debt. And if China reopens as they are reopening, that's going to be a turning point for global growth. And that is going to boost commodities even more and remove the supply chain bottlenecks that is coming out of China that we have suffered from for the last 1 year. Now my presentation becomes a little bit more colorful. So the emerging markets, you will notice that India is a bright spot there in yellow and right on top there, plus 12%. And you will notice there that China is minus 50% in emerging markets. So what this is likely to do is that rupee weakness is going to be there because of traditional factors like inflation in India. But we are going to see a lot of bond issues going to take place by Indian companies, and rupee bond sales are going to go up this year. Although borrowing in foreign currency is a big headache when your domestic currency values are going down, that's why we'll see a lot more of rupee bond sales in the coming year. Then, as I told you, Indian equities have commanded a premium over their Asian peers. That is because India has held up well. Notice they're 12% plus in this environment also. So the valuations are stretched, they're expensive, they're not cheap in India. And this is what I told you about the currency, how I see the currency pan out for not just the 1 year, but the next 10 years. This is coming straight from the currency markets, the forecast, the bid ask. And on top of that, superimposed is the bid rate and ask rate. I did this on the 24th in the run up to this presentation that I was to make to you all, wherein the spot rate is 82.79. And then the 1 year forward, all the way till 10-year forwards I've given you. which makes foreign institutional investors a little bit weary, because the moment you convert your foreign currency into Indian currency and want to convert it back, you're going to lose money because Indian rupee is weakening. Then on the right there is the expectation of India's GDP from various organizations. So Fitch is 8.5 and IMF is 8.2, so on and so forth. Our own RBI is a little pessimistic, 7.2 is what they're saying. I will go with Fitch. That's what I vote with. 8.5 seems to be somewhat okay, somewhere there in the middle. Then we are going to be having problems with our trade balance because there is going to be very high energy import. If our economy has to grow like this, we need a lot more energy. I'll talk a little bit about the energy prices. So high energy prices are going to be there. Gas prices are going to increase. And with rupee weakening, our high energy inputs, exports might be lackluster because they're still going to be recovering most of 2023. Global inflation factor, the war, which never seems to be ending, and the West GDP is likely to be growing at 0.5%. So when they're growing at 0.5%, there's no demand generation. That's why exports from our country looks sluggish. But in the context, 8.5% looks a very good. So what is it that the key asset classes have done from 2012 to 2021? This is a quilt that is normally released by global financial institutions, which is very difficult to understand what is happening here. So most of these are the performance of 1-year returns that you have got in real estate, small cap real estate, large cap stocks, cash, all of this. So these many assets are kind of ranked each year on what is the returns that you would have earned. Now I'm going towards global, because I covered India a little bit. Now I'm going towards global, then I'm going to come back to India and I'm going to like switch between the two. So this is the global asset classes performance. So which did best here, which did the worst? High yield bonds are junk bonds, bonds by inferior grade companies that give very high yields because their default probability is very high. International bonds for them are those that are domiciled outside of the United States. International stocks for them in India and China are already international stocks. Then there is large cap growth stocks, large cap value stocks. All the three is in the large cap space. Then mid cap, then real estate, then small cap, then investment grade bonds. These many. So now what I've done, I've taken this quilt that I've put here and I've analyzed that for you. I've analyzed that for you by putting it from in a simple matrix form like this, where in 2012 to 2021, I've arranged real estate and I have a large cap value, investment grade bonds, high yield bonds, all of that. I have arranged it properly. MCS stands here for mid cap stocks, MCS. LCV stands for large cap volume. So like that. So when I do an average, I find that large cap growth stocks have given the best returns from 2012 to 2021. This has given the best returns. And from the risk perspective, this has got about 12.93 standard deviation of risk. Standard deviation is a measure of risk. Larger the standard deviation, more risky it is. So notice real estate is very risky, 16.48. Standard deviation means real estate is very risky. Then when I do standard deviation divided by the average, that gives me the coefficient of variation, which tells me that the large cap stocks here, the large cap growth stocks with a very, very small 0.6507 CV is the best performing asset for the last 10 years on risk-adjusted basis. So buying a bike, you will ask two questions. What is the cost of the bike? What is the mileage it gives me? So here, this is the case wherein it not only costs you reasonable, but it also gives you great mileage. We don't want to have an asset with us. See here, for example, large cap stocks, LCS, has given me 17.515, but it has also taken 12.24 standard deviation, and that ranks second. 0.7134, that ranks second. So with this, we can rank definitively with complete confidence which of these asset classes did the best in this time frame. And then accordingly do our asset allocation. Notice what was the maximum each of this got, what was the minimum each of this had. Notice in the minimum category, notice this IS, that is standing for international stocks. 14.2 was the maximum drawdown, what we call it as drawdown. So this is how you analyze a bunch of stocks. Now let us look at speculative grade corporate bonds. How much, the higher it rises, the worse off the economic condition is. The higher it rises, the worse off the economic condition is. So look at this here, 12.6 is severely pessimistic. That's how high the yield of the speculative grade, default grade bonds are likely to go. And in a moderate case, 9%. This is what the companies have to pay to borrow money. Companies that are not investment grade. Okay, these are companies that have a very high risk of defaulting on their loans. This is the unemployment rate that is likely to prevail in February, May, August, and November of 2022. So this is the US macroeconomic assumptions on how the unemployment is going to pan out and how the high yield spread in basis points. 100 basis points is 1%. So what is going to be the interest rate on high yield debt? That is companies that are not your Microsofts of the world. They are somewhere in the middle and they're struggling to make payroll. This is what they're going to borrow at. So we are not out of the woods yet. Here on the left, you have 85 cents on the dollar. High yield bond prices are now at levels that suggest much stronger performances ahead. So this means to say that little better performance is expected from all of these companies that are middle of the road companies. Now let us come to how US dollar index has performed on the left. You see the index has gone up by 8.5% in 2022. So the index is having a lot of components. Its performance against Canadian dollar. Notice Canadian dollar has fallen by 6%, Chinese yuan 6.1%, Indian rupee 11.5%, and Swiss franc 4.1%. So here you will see that Indian rupee has really declined against the US dollar. And this is how the index has returned each year from 1973. We have the data till 2022 here. And then how did the dollar perform against the Australian dollar? How did it perform against the euro? Notice euro fell even more. So that's why Nirmala Sitharaman said what she said, that rupee is not declining, but dollar is rising. So rupee did not decline as much as euro did. Look at Japanese yen. Look at that. The Japanese yen is absolutely down in the dumps. This chart on the right tells you not just the loss of jobs in the tech sector, but also in which company, what was the kind of jobs that were lost each month of the year, what was the jobs that were lost, and who cut how much jobs is there. And you'll be surprised to know that the amount of equity wealth erosion that we have seen this year in the tech space is far greater than the equity wealth we saw getting eroded during the global financial crisis. So this year's fall in tech stocks has been unprecedented. It has been a bloodbath in tech stocks. Then we go on to energy prices. One good news, energy prices have come down, and especially gasoline prices for delivery to Eurozone is really down. There's no need to get panicky about that. So the gasoline price here, global average is 4.9. So where the gasoline prices are how much? Notice in India it is 4.8, in France it is 6, in Germany it is 7, in Ireland it is $6.8. So US dollar per gallon. This is global energy prices. This is gasoline prices. Gasoline prices. So nothing extraordinary. Some pockets. The United States is 4, UK is 7.2. So that's a little cause of a worry. That's because they banned the import of anything from Russia. They're facing that issue. Then Venezuela. Look at the energy price in Venezuela: $0.1, Colombia $1.9. So Australia 4.2, New Zealand 5.8. So this is about the gasoline prices. When we go to electricity prices, so electricity prices is somewhere here. It is $0.4 per kilowatt hour. In India, it costs you 7 cents per kilowatt hour. Notice what is happening in UK, 32 cents per kilowatt hour. In Germany, it is 44 cents per kilowatt hour. This reduces the purchasing power of a household, and they are unable to keep up with the spending that they would want to do otherwise on consumption, expenditure, and all of that. Then coming towards some more of my predictions, I'm just going to talk off the cuff a little bit. So it has been a disappointing year for both equities and bonds, no doubt. That was because the Federal Reserve was late in tightening, that is, raising the interest rates. They were too slow in raising the interest rates. The central banks around the world use interest rates as an equivalent of an antibiotic for an economy. When the economy is sluggish, when the economy is not doing well, the output is poor, the demand is poor, the central banks around the world reduce interest rates to boost demand, to boost consumption. But when there is too much of a demand, too much of consumption, too much of money flowing around in the system, there's a lot of inflation, the central banks around the world reduce the money supply by increasing interest rates. This, the Fed was very slow in doing. And when you're very slow in withdrawing excess liquidity from the system, the damage had already been done. The price hikes gets embedded into the wages. The wages start to go because workers will go complain their boss that at this wage I cannot work. You'll be surprised to know that in 1980, one burger in McDonald's used to cost just 50 cents, and the hourly wage was $3.1 in 1980. Today, the hourly wage in McDonald's is 7.5, and a burger costs you $8. So that is the quantum of problem that we are facing about inflation. So United States Federal Reserve suddenly changed their stance. They were very, very dovish. They did not want to raise rates at all. And then suddenly they almost had a personality disorder. They became very hawkish and they started to raise interest rates like anything. That spooked the markets because we like a regulator that is predictable, that will tell us what he is likely to do. And this caused a lot of problems in the UK gilt markets where the interest rates suddenly spiked and the pension funds that were using interest rates as an underlying to trade derivative transactions suddenly felt a margin call pressure where the brokers asked them to provide more collateral for holding their positions open, and they did not have the money to file the margin call. It was almost like a semi-bailout by the UK government that kept the pension funds alive still. So when interest rate goes up, what basically happens? Let us look at that. Financial assets are basically a piece of paper that gives you a claim on someone else's cash flow. If I have a piece of paper which says Infosys Technologies equity share, I have a right over the cash flow of Infosys. It could be dividends of Infosys. So I expect Infosys to give me certain amount of dividends, and I discount that dividends back at what is my required rate of return. And I arrive at what is the likely value that I will place on Infosys shares. When interest rate goes up, the value I will place on financial assets starts to drop. I repeat that. When interest rate goes up, the value that I place on financial assets starts to drop. And that's what is happening. Raise in rates will lead to a drop in the value of assets. Had Federal Reserve raised the rates earlier, say in 2021, our 2022 would not have been so bad. Because they did not raise the rates earlier is why 2022 was so bad for the global economy. So now what are we expecting in 2023? We expect with a 40% chance that the Federal Reserve is going to raise the rates. We expect 50% they will not do anything worthwhile. They will manage with the rates that is there at the moment. And post June, July, there's a 10% chance that they will reduce the rates. This is how we see it pan out. Housing market is in shambles. Housing market is very critical in the United States. and it is in shambles right now. The rentals are so high that people are not even able to afford to rent, and they're still living in the basement of their parents. That's how bad it is right now. The rents are over the roof. That is because the landlords increased the rent last year. All of this reduces purchasing power of people. Consequently, what they import is going to go down, and they are one of our very major trading partners. So if they are catching cold, we will fall sick. So it's that much closely correlated. So Q1, don't have too much expectations from them. Slow growth. Q2, interest rates may start to reduce. We may see some growth coming back. Job losses is not there apart from the tech sector. The overall net, they're still adding jobs. So the high end of the spectrum is losing jobs, but at the low end of the spectrum, they're still adding jobs. So that is not a big cause of concern. Net, they will add jobs. Then China is a wild card. If China manages their COVID properly now, this outbreak, then we are all saved. The economic activity is going to be robust in 2023 also. Otherwise, it is back to the same old conundrum. Coming to India, rubber prices have gone down, which is good. Onion prices are going down, which means inflation is quite under control. Markets are expensive. Even from a one-year time frame, earnings markets are expensive. Then what we are likely to see is that the interest rates are going to touch 8.5% right now. They are for super senior citizens, 8% for senior citizens, 7.5% for all of us. That is bad news for BFSI because banking financial services require low interest rates. Banking is a business wherein you need an upward sloping yield curve. You need the short end of the yield curve to be low than the long end of the yield curve because you will accept deposits for 3 to 5 years, you'll make a loan for 7 to 8 years. So built into that is the assumption that you are going to have continuous access to liquidity in the form of money markets. And when you accept deposits for 3 years and make a loan for 7 years, 3 years rates are going to be lower than 7-year rates. A couple of weeks back, when I observed the yield curve is a graphical description of how the interest rates in the economy are, starting from the shortest end of the yield curve, which is the overnight rate, all the way up to 40 years in India's case. When I observed the yield curve a few weeks back, there were 80 yield curves around the world which were inverted. Inverted yield curve means recession. Inverted yield curve is a classic indication that your economy is going to head into a deep recession. We need the short end of the yield curve, that is a 2 months borrowing, 6 months borrowing, 1 year borrowing rates to be far lower than the 20, 30, 40-year borrowing. That is called as the upward sloping yield curve. Why is it upward sloping? Because time value of money, second uncertainty, third one is inflation. That's why it is upward sloping. So it's going to be bad for BFSI. India's currency value going down. The only silver lining, the only person who enjoys in that situation is the IT folks. Then there is a lot of wage inflation. So they will be struggling with the increase. They'll have to increase salaries to attract talent. Then exports will be down. So 2023 seems a little challenging. Wages in the construction sector is expected to be good because government projects are going to come online and the wages in the construction sector are going to do well. CapEx is likely to expand. Companies are likely to spend money to expand CapEx. Then now I'll give you some doomsday predictions of what is likely to happen in the worst scenario. So right now, the world is awash with 350% debt to GDP. That is ridiculous. That means households are in deep debt, financial institutions and governments and many countries are insolvent, what we can call it as zombie. Zombie is one which is not even able to pay interest on the loan, let alone repay the loan. So you have two neighbors who are already in the zombie state in India's own neighborhood. So that is going to spread. The contagion is going to spread. Interest rates. Governments can service debt so long as interest rates are low. Governments will not be able to service debts when the interest rate starts to increase. And now we are seeing interest rates increase. All right. So that is one doomsday among the many other things. Okay. Inflation, what it does, I have borrowed money. You're the banker. You have told me, give me interest on this money, Kirron Bindu. I'm very happy. I give you interest. You have told me, pay me after 7 years. No problem. Inflation makes me a winner. Because 7 years from now, when I have to pay you 1,000 rupees or 10,000 rupees, the purchasing power of that 10,000 rupees is nothing. It may be probably 3,000 rupees of today. So inflation is a tax. Inflation shifts wealth from the saver to the borrower. Inflation shifts wealth to the debtor. So that is one thing that I wanted to tell you. Inflation can reduce the real value of nominal debt at fixed interest rates of long duration. It's a tax, taxing creditors and savers and redistributes income to borrowers and debtors. So it's a tax that is levied by the central bank. As you know, tax can be levied only by the Act of Parliament, but this is a tax that is levied by central bank and not by the Parliament. So it's a combination of bad policies and bad luck that led us to this loose monetary policy from the global financial crisis we are paying. If I were to tell you all, get up at 5 o'clock in the morning and go for a run, it's good for your health, you will not be very happy. But if I were to tell you all of you can get a hit of a narcotic, psychotropic substance, you'll all feel very happy in the next week, but it is going to ruin your long-term health. Low interest rate is the equivalent of a narcotic, psychotropic substance for an economy. A lot of bad things happened because of low interest rates. Photos of chimpanzees were being sold at millions of dollars. That is the ridiculous levels of what low interest rates had done. So we need to watch out for supply of labor because the COVID impact on supply of labor is there. Russian invasion, no sign of Russian invasion getting sorted anytime soon. Then oils and metals will be impacted by both of the above, as I've told you. Then zero COVID policy, hopefully zero COVID policy will not be there anymore, and China is going to reopen. And I'm going to talk a little bit about Britain. Britain 2-3 years back inflicted an injury upon itself. It's called as Brexit. And when Brexit happened, one of our very major trading partners, UK, it caused a situation wherein if you are going to import into UK, you need a whole set of new licenses. Because before, if you had the license to export to Europe, you were good. But now you need another set. That increases cost of doing business in UK. So Brexit was a friction in the global economy. It destabilized a lot of their relationship, and they're struggling consequent to that. Then there is going to be further deglobalization, wherein people are going to say Atmanirbhar, and people are all going to start to produce in-house. So Atmanirbhar is a game not just India can play, but 180 other countries can play. So that is protectionism. That is basically where you are saying that we'll do everything in-house. China can also say the same thing. Japan can also say the same thing. Then who is going to take our IT products? So it's a very dangerous game to play. Then there's also a problem of aging population around the world that is going to have an effect. Then climate change, how did I forget that? So all countries and companies are putting their dollars to work to ensure that they retard the change of climate. So climate action, it is called as. Then you will see a stagflationary environment in the 2023. That is reduced growth and increased cost of production is going to be there in 2023. Those are my predictions that I kind of wrote down, And then this is, I think, my one of my last slides, the natural gas. Natural gas at the moment is 9 cents, and natural gas prices are on their way up in Europe. So that is once again a cause of concern for Europe. And this is the inflation, double-digit inflation. Notice India is at 6.8. Notice the rest of the world. This gives you the inflation in every single country, literally. Top 10 highest inflation. Notice Suriname, Iran, Sri Lanka, Turkey. So basically what this means is in the morning, the price of bread is like 12. And in the afternoon, the price of bread may be 13. It's growing so fast. There's no stability, and you don't want that because your wages are fixed, and most of them don't have wages linked to inflation. So only very few % of the population has wages linked to inflation. So they are struggling. Look at Zimbabwe, 269. Zimbabwe's problems never cease. For 10 years now, they have been in an unstable problem. Venezuela, 156. So we have to be thankful that our economy is reasonably well managed. 6.8% is our inflation. And notice in our neighborhood, only China at 2.1 is a major economy that has small inflation. Russia is struggling. Brazil 6.5. Latin America has a perennial problem with inflation. They have always used currency debase as a strategy to pay off their debts and manage their budgets, which is a bad strategy. They never seem to learn from it. Venezuela 156, so on and so forth. And the developed world, Poland is at 17%. Then you have Spain, which is having a lot of inflation, 7.3, and Portugal at 10.1. So this was, I think, my last chart, and I'm done. Yeah, this is my last chart. So I'm open for questions. I think a lot of questions may have flown in. You can raise it one by one, and I'll answer it to the best of my ability.
Thank you, sir. It was indeed a very informative and valuable session. You touched upon opportunities, and you told that it's going to be a multi-able market. And you told that there is a reduce and expanding power of households. You gave all simple examples in such a way that we could easily understand. Thank you, sir. Now I'll take up the questions one by one. So the very first question by Praveen Reddy. How COVID new wave will have impact on our financial condition?
Yeah, it is going to have the same impact it had on the first time, depending on how severe it is. So if it is not too severe, if there are no lockdown, there is no supply chain bottlenecks, then the workers can continue to go to work and there is not going to be impact on consumption. Simple. Marico Industries in their conference call said that if people cannot even go to the bazaar, how do we expect to sell parachute oil? So their revenues dropped off. So you can't go to the supermarket, you can't buy anything if there is a lockdown situation, and the sales are going to stagnate. Companies are not going to be able to sell cars. Household inventory is going to stagnate. So all of those bad things are going to happen. But if there is going to be a mild COVID, which is just like a seasonal flu, that what we saw sometime in the last year, which was not very serious, no serious hospitalization, then it is going to be absolutely normal. Watch for the way stock market reacts. Right now, the stock market is a little worried that how severe the COVID is going to be. Once a clarity emerges on how bad this COVID is going to be, the stock market is going to bounce. So keep a watch on stock markets to know how really COVID has impacted.
Thank you, sir. The next question is from Mr. Jai Kumar Suryanaraina. What may be the effect of US recession on our market?
Yeah, so if US is in a recession, every country around the world has to worry because they are a major trading partner. They buy a lot from us and we buy a lot from them, and travel is going to get affected. They're going to shut down airports. So that is going to impact people who are going there for work and for studies and otherwise. Visits are going to be curtailed. So general economic activity is going to come to a low ebb between the two countries, which is not good for earnings of corporates of both the countries.
Okay, thank you, sir. So this question is directly on the investment by Francis D. Costa. What are the best industries to put money in 2023 that have the ability to increase in the following 5 to 10 years?
Okay, this is purely from an investment perspective. Okay, from an investment perspective, I believe the same themes are going to continue for the next 10 years that you saw for the last 10 years, because in India, the market leaders are really leaders by a mile. So if you take paints, the market leader in that paints is not a leader simply because there's nobody else. It is simply because they sell millions and millions of liters of paint. And they are sitting on top there with the highest amount of sales revenue. They have the market reach and muscle power. They are going to continue to create wealth. So if you take two-wheelers, the market leaders are really leaders there because they have got that market reach and muscle. So I do not think this decade is going to unseat the leaders, because there is nothing that we can take away from them. They have managed to negotiate technology challenges very well, new designs. They have managed to streamline their supply chain, managed to streamline distribution. They have literally cult following among customers. Customers are going to upgrade, are going to go ahead with them. So the leaders are continuing to perform in the next 10 years. But the new young companies that are coming up, many of them have proved to be a disappointment, and they have not really given us the kind of returns that we were hoping for. They were trying to leverage new technology and doing things like that. So that remains to be seen. The jury is out on that. I can't spot any one company that if it is a listed space, it is probably going to do well. And anyway, in an open forum like this, I will not take company-specific names because that is simply not done. You never know whether I hold any of those shares in my portfolio. So I'm not going to give any specific names, but I'll just broadly tell you that those companies that have done well in the last 10 years, exceedingly well, they'll continue to build great wealth in the next 10 years also.
Thank you, sir. I think Ms. Shanta Kumari also almost had the same question. She would have got the answer by now. The next question is by Mr. Mohan Kumar. Will Nifty move up in 2023 first quarter?
I have no way of telling you that. There is too much uncertainty.
So the next question is by Mr. Jeevan Singh. Which market or sector is not good to be impacted by COVID or any kind of crisis in the upcoming year?
Okay, any sector that is a high impact sector, high contact sector, wherein you have the customer has to come and then the transaction can take place, like your hotels, like your airlines, wherein the customer has to physically come, is going to get impacted by COVID. If the customer can be serviced remotely, then it's not going to be impacted by COVID.
Yes, sir. So the next question is by Anjan Kumar, Mr. Anjan Kumar. Do you really see a recession around the corner? In India, no. I don't see a recession in India for the next 30 years. Simply because India is literally like a continent. Ever since they introduced GST, we have become like one common market. And in India, every day when 1,400 million people wake up, they need milk, they need butter, they need wheat, they need to go to work, they need to go to schools. So they need transportation, they need clothes. So in the evening, they would want to enjoy, they want entertainment. They're consuming data like anything. I don't see a recession in the realm of likelihood in India, definitely not. World, yes, there's a demand constraint. They are heavily leveraged. Households have borrowed a lot of money so that they reduces their capacity to borrow even more money. But India, certainly not. Watch out for the sales of tractor. That will tell you how the rural economy is doing. If the tractor sales are very good coming out of Mahindra and Mahindra, then rural economy is doing very well. If the tractor sales are bad, then the rural economy is hurting. Yeah. Sir, and is there any impact on education sector? So this question is from Mr. Rajat. Back in 2000, we saw a small increase in the online classes space, wherein many universities propped up offering online programs, online degree. UGC also approved online degrees and things like that. I don't believe that is going to sustain.
because students have realized that the learning outcomes are not comparable with when they go and physically sit in a class, see their teacher, understand from the teacher, ask them 10 questions, then meet with their friends, the social awareness that creates, the way you manage your emotions, all of that creates a holistic person, which is not possible to replicate in a online setting. So we have also realized that online classes is for something like this, for a very specialized and niche topic wherein people can join from anywhere, and these are people who are terribly interested in that topic. So we don't need to monitor them to see whether they are really listening or not, because they've come here because they're very interested to know more. So those are the kind, for example, if 10 dentists want to get together and exchange knowledge on a particular procedure, online works. But it does not work so well if you are studying for a degree. So education is not going to get impacted so long as parents and guardians can find the fees to pay for the individuals' studies. And banks today anyway are giving you a lot of loan for studying. So any which way, I don't see an impact for education from all of these events.
Yes, sir. This is a question from Ms. Rekha Mahajan. Can we trust on SIPs, particularly through apps like Grow, etc.?
Yes, I have no problem in advocating that SIP is a very good way to create wealth. I am particularly fond of single stock SIPs, which has been a great wealth creator. That means you allocate 10,000 rupees every month and buy one stock only. Same stock you keep buying. So if you think that, okay, TCS, don't go out and buy. I'm just telling you, I'm giving you an example. Statutory disclaimer, I own TCS shares. And it just rolled out of my mouth, so I'm going to stick with that. TCS, great company. Every month, buy 10,000 rupees worth of TCS shares. Put it aside, forget about it, go on with your life. Don't bother attending one more seminar on investing. Do that for 20 years. Then what's going to happen? You're going to have a whole lot of shares of TCS multiplied with the 20th year market price, could be 16,000 rupees. Your capital invested would have exploded. I have done a back testing on this, and in a simple time frame of 2017 to 2022, on one stock SIP, 5 years, 10,000 rupees if you invest, you would have invested 6 lakhs rupees of your own money. In this particular company, I don't want to name, 6 lakhs rupees grew to 12 lakh rupees. It is not impressive. I know youngsters will be saying, hey, only 12 lakhs. This is real life. This is not 15 din mein paisa double scheme. This is hard work. This is not magic. Investing is not magic. So 6 lakhs becoming 12 lakhs in 5 years without great effort in an environment of low interest rates is very good. Now, here is the kicker. If you did this from 2010 to 2022, for 12 years, 12 lakhs has become 40 lakhs. The longer you follow through on this strategy, the higher the wealth you're going to build. The quicker you start, the longer the runway you have, and you identify a stock and continue to buy that stock. Any market leader that has done very well, a very respected name, well-run, well-managed company, great corporate governance, does not have any legal issues, employees love to go to work for it, people buy their products, buy such a stock and stick with it for 15, 20 years, and then you will see wealth creation. So SIP, I have great respect for, no problem. And any one of these apps, they are fintech apps. So fintech is basically trying to leverage technology to go to the uncatered service of the marketplace. So that's what fintech is. So I have no problem in using any one of these apps myself.
Thank you, sir. Thanks for your answer. And mostly, many of the questions we have wrapped up. So the next question is from Mr. Sachin Hebar. What is the overall economic progress we can look ahead at present situation? Does financial burden will increase on individual?
All right. Let me answer the first part of that question. What is the economic growth that we can see? If we are growing at 8.5% on the current rate of $3 trillion, then pretty soon in 4 to 5 years, we are going to be $6 trillion. So there is a research done by one of the companies headed by a gentleman who is infamous now because he's so rich. He says that between 2040 and 2050, India is going to add $1 billion to its GDP every 18 months. So we are living in really exciting times. 2022 to 2040, the next 18, 19 years are going to be really high growth because everybody expects India to do very well. And only we can possibly kind of take the vacuum that has been created because of China's own folly. And people are moving out of China because of they want to have China plus one policy. And many of them are going to Vietnam also. But I see great times ahead for India, and I'm always bullish on India, and I will not short India in any given point of time. Second is, I feel financial burden is good. I don't feel it is bad. I always advocate youngsters, borrow money, buy a house, borrow money, buy a car, borrow money, buy a mobile phone. Don't wait for tomorrow to come. When you borrow money, it shows that you have confidence. Simple. When you don't want to borrow money, it means that you don't want to take responsibility. So when you have an EMI of 30,000 rupees to pay, we will pay. What is the big deal? We will earn well, we will pay. We'll continue to pay, we'll buy a house, we'll buy a car, we will go on a holiday, we'll keep our family members happy, and we will pay the loan. If every one of us does that, remember what's going to happen. Somebody's expense is your income. Your expense is somebody else's income. So the overall income levels of the economy is going to go up exponentially. Why should a hotel in Goa make a hotel if nobody is going to go there? Why should Tata's manufacture a car if nobody is going to borrow money and buy their car? Please use debt wisely. All of those things that gives you a good life, a comfortable life, is good debt. But don't unnecessarily use a credit card to buy stuff that you don't need. The fourth watch that you don't need that is there in your drawer is not going to add anything to your life. But a car that you need to travel safely adds a lot to your life. So please don't treat all debt as the same. Student debt is a good debt. Debt to buy a house is a good debt. Debt to buy probably your mom jewelry is a good debt. I love gold. Gold has outperformed stocks in 22 years. It is a very stable source of value. So I will not badmouth gold. Gold is a very good investment. Our grandmothers were right in putting money in gold.
So thank you. It was such a wonderful session, and the question answer session was amazing. In fact, it was personally also helping me so much, the few ideas that you gave. Such an informative and very beneficial session, sir. And gratitude is the healthiest of all human emotions. The more you express gratitude for what you have, the more likely you will have even more to express gratitude for. I, Soumya M, on behalf of GIBS Business School and the entire GIBS fraternity, extend my most sincere thanks to Mr. Kirron Bindu. Thank you for the enlightening us about expectations from financial market in 2023. Thank you for all the useful tips and information, sir. I'm sure that the session will surely help the audience to understand more about startups ecosystems. I extend my sincere thanks to all our associates, beloved students, and the educational fraternity for making today's session resounding success. GIBS always believe in seeing is believing. I bet that you will love the state-of-art corporate infrastructure, and you also love meeting the team, innovative minds at GIBS who believes in spreading the power of positivity. Looking forward to meet you all in person at our campus. Thank you, one and all. GIBS is known for knowledge sharing and its hospitality experience by visiting our campus. And there are important announcements. You can watch the video of all the previous webinars on YouTube. The e-certificate of this webinar will be sent to your registered mail ID within 30th December 2022. GIBS is inviting everyone for the next IRE talk on enterprise blockchain value proposition by Mr. Kiran Babu CV on Jan 5th, 2023, 5 p.m. in India. Kindly follow us on all social media platforms, LinkedIn, Twitter, Telegram, Instagram, Facebook. Be with us always. Have a great evening. Stay safe, stay healthy. Thank you so much, sir, for joining us.
Thank you. Thank you all. Thank you all. Have a good evening.
Thank you, sir.